Welcome, everybody. We're really pleased to invite you or to welcome you to join us for NYU REIT Symposium Industry Day. This is our second panel of the day on ESG benchmarking in REITs, private equity, and municipal bonds. Pretty excited to be here. This is our first REIT Industry Day that we've done at Schack. And the panels have been great so far. There's only one so far, so hopefully we continue the tradition. I'm Matthew Kwatinetz. I am a professor at Schack Institute of Real Estate and also the director of NYU's Urban Lab, where we focus on inclusive growth, which also is called the quadruple bottom line, integrating aspects of economic prosperity, social equality, environmental sustainability, and cultural vitality. Most of what we focus on is real estate and in general impact real estate. We have a few different research areas on inclusive growth, including housing and economic development, sustainable infrastructure and development, and public-private partnerships, ESG and impact capital formation. Schack Real Estate Institute has been around since 1967. We're really pleased to still be going here and continuing to try to be relevant at the intersection of practice and academia. We focus both on private and public sector, and in the private sector, nonprofit and for-profit. We're very excited to be able to deliver content that really integrates the best of industry with what we hope is the best of the academy, combining not only at the Schack Institute of Real Estate, but across all the schools of NYU. Today, I'm really pleased to be joined by two of our graduate researchers, Jun Kang and Troy Sutton. They have been working with me to develop some materials for this panel. We also will be working together to actually publish a paper that summarizes both this panel and future directions that we think are interesting in research. So in terms of what we're talking about today, why are we talking about ESG benchmarking? Well, Bloomberg has projected that global assets under management for ESG are supposed to reach 50 trillion by 2025. That would actually make ESG categorized assets 1/3 of total global assets under management. This has been a very meteoric rise. It's exciting for those that would like to see the integration of social value into investing. Of course, there has been some politicization and some pushback on some of these issues, but there's no mistake that this tag to asset class is something that is quite prevalent, not going away anytime soon. But one of the problems is the problem of definition. We know that in some cases, ESG funds are charging higher amounts, and there isn't a convergence of definition on what it means to be ESG, especially if we try to think about an apples to apples comparison between two assets, even in a very specific real estate space, let alone more broadly in the asset market. The specific real estate space, if we see two real estate developments and one of them, if they have the same economic return and both claim to be ESG compliant, how are they measuring and reporting out what that means, and how are investors able to make decisions between those things? And in the real estate realm, a study that we've done for the last year, that's probably a little bit even easier to define those things than what we'll talk about today, where we broaden out to real estate private equity, the municipal bond market, and also real estate investment trusts. This quote I'm showing here from the commissioner of the SEC talks about the fact that while we saw this rise, we also are seeing agencies, rating agencies or research agencies actually stripping designation. So this is a chart from the Forum of Sustainable and Responsible Investment, who's been tracking this rise of ESG incorporated funds and fund strategies. You'll notice that between 2020 and 2022, there was a sharp drop off, and that had a lot to do with them evaluating that some folks were greenwashing, saying that they had an ESG metric, but either were unable to accomplish it or maybe were a little bit disingenuous with what it was. So that's the context and the backdrop of what we're talking about here today. That's the most, hopefully, that I will speak. But now I am really pleased to invite up the panelists for today. Soojin Kim from Preqin, Nicole Funari from Nareit and Lourdes German from the Public Finance Initiative. And I'm really excited to invite them each to give a little briefing of what they are thinking about in this area. And then we'll go into general questions for everybody. So believe we're starting with Soojin.
Thank you, Matthew, and thank you everyone for joining today. Really excited for our panel discussion with our other panelists. I'd like to start by just a quick few slides. And before I get into some of the data, something that I want to share is just a quick introduction of who Preqin is. So we're an data provider for alternative assets. We have 15 offices globally, and we do focus on all asset classes from fundraising to performance deal, all the way down to the asset level. ESG is one of our products that we offer. However, with there being other products, I do want to identify that for the sake of today's conversation, any data that I do reference is specific to our real estate data as well as our ESG data. So to get us started, what I wanted to look at is the rate of disclosure in private markets, because with the nature of private, we have a very, very opaque landscape. And when it comes to real estate, a lot of the time, it's not necessarily their intentionality of sustainability, but it has a lot to do with what is available on the public domain, what they feel comfortable sharing with their investors, and what signals that these are sending out to the market. So when we look at certain indicators that we're tracking across our Preqin ESG transparency product, which looks at 37 different indicators that are aligned with frameworks such as the PRI, SASB, ILPA, TCFD. These are very well-known ESG frameworks globally. However, when we look at disclosure rates, which we'll touch upon a little bit later in discussion as well, the disclosure rates across every single firm, across every single region, across every single strategy tends to be exceptionally low. So what we're seeing here is a breakdown of real estate firms that have an ESG investment policy publicly disclosed somewhere through their firm website, through a sustainability policy, through a report that maybe they've shared with the PRI, TCFD, et cetera. And we'll notice that even the front runner here, so we have Africa, which at proportionately has 30% of their firms disclosing an ESG investment policy, followed by Europe, which has about 20%. So even your top two front leaders are tapping out about in 1 in every 3 or 1 in every 5 firms that explicitly say within our investment policy, these are how we align with ESG issues. Um, regards to our own local jurisdiction here in New York City, North America caps at about 4%, which means 1 in every about 20 firms are disclosing ESG policies. I do want to note that these are all ratios out of 100%. When we think about North America as a landscape, this tends to be our largest market segment. So this also plays a large influence on it as well, again, with that huge denominator in North America, thousands above a lot of these other regions. That also will influence the data a little bit here, so something to keep in mind. Our next slide here looks at different fund labels that we're tracking. So currently Preqin is tracking 7 fund labels between climate, ESG integration, impact, SDG, Article 8 and 9, and Sharia compliance. Well, a few of these are a little bit more region specific. So those of you who are not aware of SFDR Article 8 and 9, these are a little bit more relevant in the EU segment, but still helpful to be aware of kind of what the different regulatory looks like in different regions, as Article 8 and 9 are very popular with the EU, which is considered the front-running region of ESG data and sharing on their reporting at the fund level. Sharia compliance is a little bit more common in the Middle East. These are very much aligned with values-based investing. So really what we're seeing gain a little bit more traction in the United States is the second and third fund labels, which are ESG integration and impact. And what these bars are showing are the number of funds that are in each of these labels, and the pink dot represents the sum of the fund size. So for something like ESG integration, we have about a little over 50 funds, and then the total amount of aggregated fund size in USD billions is right around $40 billion USD for all of those funds. And that's including ones that have closed and also ones that are still raising. So these are spanning across multiple different vintages. For something like Article 8, these have fewer funds, but they have larger fund sizes. So what we're seeing here is that for some of these labels, there are typically trends that fewer managers will raise these funds, but they'll be very large in size, or vice versa, kind of depending on what the spread looks like here. A lot of variances can play a factor into things like size, popularity in region, and also whether or not a firm ends up keeping a label, such as regulation, which I think will be a really interesting topic, particularly in the United States, when it comes to how managers are able to label these funds, what reporting that they're expected to give to any regulators, to their investors, and things that they are mandated for kind of across the business. So I hope that that is kind of like a teaser for some of the conversation that we're having today in terms of the fundraising landscape. So I'll stop sharing my screen and I will pass it back to Matt for our next introduction. Thank you very much.
Thank you so much, Soojin. I can't wait to get copies of those charts. There's a lot of interesting stuff there, especially the last one with the number. So next, I wanted to introduce Lourdes Germain, who will be talking about the municipal bond market.
Great. And thank you so much for this wonderful invitation. My name is Lourdes, and as you know, I'm the Executive Director of the Public Finance Initiative, a nonprofit that focuses on programming that centers the values of equity, sustainability, and inclusive growth in public finance decision-making. And what I'm going to cover today is how ESG presents in municipal bonds, specifically the municipal bond market. I'm going to start with a really quick pop quiz. I'm going to show you 3 photos, and I want you to think, what do these photos have in common? This is a demolition project in Detroit, a water tunnel in Washington, D.C. of the D.C. Water Authority, and an apartment complex in California. And if you're thinking that all of these are projects that have been funded with ESG designated municipal bonds, you would be correct, because as we're talking about today, the sector is growing, as you saw from Matt's opening presentation. And when we think about what are ESG designated municipal bonds, that's basically where our government entity decides to borrow money to fund a project. And they give a signal to investors that there is some social, green, sustainable, climate, sustainability linked focus within the deal in order for those investors to come to the table and to think that there is something that unites the deal's financial considerations with an ESG value. And as we'll talk about, they could be very different kinds of investors who are looking for something different in that signal. But just to show you how large the market is growing and what it actually means to do that kind of deal, this is an example of a screenshot of when Detroit did a demolition borrowing. So basically they borrowed money to demolish blighted properties and make sure that that could be an engine for change in economic development and the revitalization of neighborhoods. And adding the label of social to the bond deal brought investors to the table who presumably would not have looked at this deal for purchasing an ESG portfolio. So basically growing demand for the offering. And it's not just Detroit that's doing this. This is a UNPRI chart that shows how the market has grown exponentially since 2013 and continues to do so. So there's about 550 to 600 billion of combined debt issuance across the multiple categories of what that are emerging as ESG designations for municipal securities by the end of 2021. And even though the municipal bond market, which is a $4 trillion market, is incredibly fragmented and shows immense variation with about 90,000 different issuers, there's no current accepted or adopted industry definition of what an ESG designated municipal bond issuance is. So it really is up to the issuer and the market to define that deal by deal. And there are 3 points of convergence that are emerging that I've seen throughout my research. One is the majority of the market overwhelmingly cites to the International Capital Markets Association as principles when they say this is what a designated bond is, and here's proof for investors, that we're adhering to some standard that's voluntary. An overwhelming majority, about 97% of deals, are citing to the UN SDGs, specifically saying the way that we're using the money from the deal also speaks to this broader principle of sustainability and a known global standard. And overwhelmingly, as I said, about 98% of deals specifically give meaning to the designation in what's called the use of proceeds, saying, why is this deal an ESG deal? Because of how I'm spending the money on the project that I'm raising money for. And that seems like a natural thing when you think about, well, where do we give meaning to an ESG assertion? One really big area of difference, as I alluded to before, is what are investors looking for? When issuers are labeling the deal and adding a signal in the title of an offering that it's social, green, climate focused, or sustainable, they're not speaking to investors that are of a single mind. One of the biggest divides in the market is that some investors are looking at ESG from a credit lens, while others are looking for impact. Investors who are looking at ESG from a credit lens in the municipal bond market basically are of the notion, and this is an oversimplification, that if I'm examining non-financial factors, it's going to make my portfolio stronger. It's going to make me more insulated against risk. And I'm really focusing on risk-adjusted return at a whole nother level than if I wasn't considering all these other, let's just say, non-financial factors in my credit analysis. The other side of the spectrum in green are impact-focused investors who specifically want to see place-based conditions be better. They want to see social governance and environmental impact alongside a financial return. And believe it or not, that is a very true divide in the market that we can speak to that ties to the economic considerations when issuers do these deals and have to cultivate investors to come to the table who are not of one mind. So how is the ESG designated bonds market evolving? And this is where I'll end my presentation, because there are a number of trends that are really unique. And the biggest one that we have found in our work, and this is a signature project that we are leading with the funding of the Robert Wood Johnson Foundation, is when we look at the racial equity focused borrowings within kind of the S in ESG, socially focused issuances, we're seeing a paradigm shift. That's communities, issuers, and governments who are saying we're not just about the use of proceeds. We are doing so much more to express and align to that policy commitment, that practice commitment. And they're centering racial equity holistically and basically showing us that there's a way to give meaning to the S in ESG that goes beyond the use of proceeds, which is vital, but not the only thing that we should look at. And that includes with 5 of the practice areas that you see on the right hand of this slide, of looking at the actual plan of finance and whether it undermines or accelerates equity outcomes, looking at the policy commitments at an issuer level, and whether or not issuers are actually committing to policies and practice changes as a jurisdiction that will bolster what they're trying to do with one project in a wider frame and others. And one of the other areas that's really significant and that probably inhibits of many factors why there isn't one standardized way to measure change is when we say, what does it mean to express a goal within the S and ESG? There's so many different ways that communities across America are doing this. And this work that was done by Urban American City and Ideas in Action begins to show just a little bit of what it means to express an equity proposition. And saying, are you trying to improve access, inclusion, well-being, or assets for communities of color in your jurisdiction? And what might you measure that's different to see whether you're realizing that equity proposition? And I show this just to show that the level of complexity and nuance in the market is growing, but it's heartening because it shows the maturity of the market and just what's possible if we think about these deals as a meaningful intervention beyond a way to bring investors to the table. So with that, thank you for letting me introduce these thoughts, and I look forward to the rest of our conversation.
Thank you so much, Lourdes. What great thought on the topic, and I'm really interested in expanding those definitions of equity and how we think about it. So last but not least, Nicole, why don't you give us your introduction?
Hi, everyone. Thanks for coming out to hear us speak. I'm Nicole Funari, Vice President of Research at Nareit, which is the Industry Association for Real Estate Investment Trusts, or REITs. And when I think about our approach to sustainability, we have our lobby arm, we have our membership arm, and we have our investor outreach arm, which may be a little surprising, but just to explain that Nareit in a certain sense acts like an investor relations for the entire REIT industry. So we do a lot of direct communication with investors. And so when we think about ESG at Nareit, we have to focus our lens in a few different areas. So for our members, we provide guidance and research on sustainability issues and on metrics. We have conferences, we have practical reference guides, we have all these things to help REITs either get started or enhance their ESG practice and their reporting. We also advocate for member interests. So our lobby arm worked with the SEC to get the solar tax credits available for the real estate industry to use to encourage solar, along with the tax benefits that other industries were getting. And like I said, we talk directly to investors, and we know that investors love REITs for their real estate benefits, for their completion portfolio, but we can also encourage them to consider REITs as some of the top quality ESG performers that many of them are. We provide this information because we are getting demand from investors on ESG. This is not something that we're necessarily shouting into the void. This is something that investors want, and we have to be responsive to, regardless of whatever the political climate, tends to be. And I know that's something we'll probably circle back to. So just to give a few examples of what there we go. So a couple of the things that I work on and that Nareit provides, we have what we call our ESG dashboard, where we look at the top 100 REITs and we do a deep dive on their ESG practices and kind of present a bunch of information on what REITs are doing, our top 100 REITs, which is about 90% of the equity market capitalization. And so you can see this is a snapshot from the ESG dashboard. For the past 2 years, we've seen that 100 out of 100 REITs are reporting on ESG. And that's up from 60 in 2017. So we've really seen a lot of progress in the last few years, which we're encouraged by. Here's another example of what's on the REIT ESG dashboard. So again, we look at sustainability goals, we look at disclosure of social policies. There's quite a bit on there if you go to our website. And so that's something we do for our members and for investors and the public at large. Another thing we do is we have 2 different surveys. We have the ESG survey, and we also have a DEI and compensation survey of our members. And this is really helpful. Again, we publish a lot of this information. It helps us guide what's happening in the industry, but it also helps our member companies benchmark their efforts against each other and provides a useful tool for them in that way, so we can keep pushing the envelope. And so this is just a snapshot of information from our ESG survey that looks at what the top requests are coming for investors based on different ESG topics. And again, this is something investors want. We can't afford to ignore it. And you can see, so this is what was surveyed for 2021. You can see the 2020 ranks are in parentheses, where, this past year, it flipped back to more environmental topics, GHG emissions and climate change. But in 2020, after the Black Lives Matter protests and the murder of George Floyd, diversity and inclusion was really top of list on everybody's mind. So these things change, and that's something that we need to be mindful of and help our members with. And then the third thing we do every year, which we don't usually publish this, and I push to get this slide in here because it is near and dear to my heart. We help our members think about how they perform in the different ESG rating systems. And I love this chart because you can see there's no consistency in terms of how these rating systems work, in terms of what they're measuring, in terms of what they're evaluating, and in terms of how the different sectors perform. So, you know, in some places, real estate for sustainability is the top performing sector, and in some places it's the worst. And so this type of thing is something we keep our eye on, and we try to tell our members and try to understand what the differences are and how REITs can better explain their ESG proposition to maybe do better in these rankings, but also keep in mind that it may not be possible to be the top at all if they're so different. And so I'll leave us there on that point in terms of kicking off this robust ESG discussion and what it all means and what we measure.
Great. Thank you, Nicole. I'm really excited about this panel. We had an amazing pre-call that felt like a panel all in and of itself. So try to recreate the magic here. I'd like to just start by zooming out a little bit. We have a fairly diverse background of audience members. And so, Nicole, I'd like to turn this one to you to kick us off, just to explain and define ESG and contrast it a little bit with other movements like it that we've seen recently that are still contemporary, CSR and SRI, and just give a little bit of context about what we're talking about when we speak about ESG.
Sure. So I actually started out in SRI 20 years ago, socially responsible investing as it was known then, for one of the largest asset managers. And I think what the change of terms and the change of lens, if I can just take us back in time a little bit, I think it sort of helps provide the context for people as to where we've been and why we've shifted in this direction. So in Europe, the socially responsible investment movement really came out of the environmental movement and was very focused on the environment. And I love that, Soojin, you talked about Sharia. In America, the socially responsible investment actually came out of religious investors who didn't want to invest in certain types of industries and practices, a lot of things like no weapons manufacturers, that type of stuff. So it came actually more from the S side in America and the E side in Europe. And so socially responsible investing, you know, it started to sort of merge together into those two lenses, kind of came together in both Europe and in America to a broader context. Fast forward then, you know, so that's the investor side. And as investors started to demand better performance and more disclosure on these fronts, you have CSR, corporate social responsibility, which is the corporate lens, pick up to sort of say, okay, what are we doing in terms of these issues and how can we communicate this better? Which then I think gets us to where we are now with ESG, which is agnostic as to, you know, it's not purely corporate, it's not purely investor, it's the umbrella of all of these things when we think about environmental impact, social inclusion, and good governance. That is a perspective for investors, for corporations, for the government, for standards makers. It became this bigger umbrella to bring everyone inside. Having said that, with all those different moving pieces and evolutions, I think it's really hard for us to define it in a consistent way.
It's interesting, even in the way you just described it, the S started out coming from the religious community and different practices like not supporting weapons manufacturing, and migrated to talking about diversity and equity under the same heading. So I guess that brings us to a question for everybody, which is, are there commonly agreed upon standards in your sector for ESG? You talked about it a little bit in each of your presentations, but I'd love to allow you to freeform a little and maybe interact a bit about that question. Soojin, do you want to start?
Sure, I'd love to. And I think that's what makes ESG a really exciting and dynamic space where we can have conversations like this, because regardless of which financial sector you're in, which industry that you're in, ESG tends to be a very cohesive conversation that I think transcends a lot of these different spaces. So I think something a lot of people who work deeply in ESG kind of recognize, which sounds a bit counterintuitive, is that a lot of these terms don't have definitions, because a lot of them change with time and they change with sophistication. Something that really all players are looking for, whether you are an investor or a manager, or even if you're just the general public reading a new article about sustainability in the New Yorker, everyone's kind of looking for the best kind of in vogue terms in order to have a really just deep conversation about what sustainability means. And right now, I think the most popular term is ESG, but to Nicole's point, 10 years ago, a lot of people were saying socially responsible investing. And we also have impact in the space, which there's also a lot of heated debate, because some people use that interchangeably. Some people feel very strongly about those being entirely separate terms. So I think what we can all do is recognize that while we're working towards better definitions and better reporting towards all of these things, we still need some agreements, which is why, and especially important for private markets, we need that level of transparency of, okay, I need to know everything you're doing, and this is everything I'm doing. If we can find some similarities, that's generally what we can agree upon, so that there's some comparison here, and we know that we're generally speaking about the same things, but there's a lot of room for interpretation. So a lot of conversations lead to, I don't define it this way. This is how I define it. They might define it another way, and they're still both accepted, even though that they look very different. But yeah, that's my response. I guess, Lourdes, I'll pass it to you for your thoughts.
Yeah, and I think there are some real similarities to the municipal bond market. Right now, the only voluntary principles that the market is adhering to in sort of giving meaning to the designation are the International Capital Markets Association principles, known as ICMA. And they put forward the green bond guidelines, social bonds, sustainability, and sustainability linked bonds, and outline at least the criteria that you as an issuer want to think about. And I think it did create a strong step forward and foundation for the market, because at least it outlines that there should be an adherence to the use of proceeds, and adherence to thinking about post issuance reporting until the proceeds are expended, and even beyond that in some cases. And also including other considerations that issuers should think about. And it very much then devolves to the issuer's own use of then other frameworks to enhance and go beyond that, and to also think about how they're going to basically create a measurement framework, regardless of what lens they're taking on ESG and their designation, to basically give meaning to it for investors who they're seeking to bring to the table. And separately, the other body of that I would allude to would be the UN SDGs, because from an issue area standpoint, I can see why as a global standard, many issuers say there is immense variety within the Sustainable Development Goals to say, this is how I build a nexus from what otherwise looks like a project that often is a brick and mortar project in a jurisdiction, and say, this carries a value. This is driving forward some element of either social change or some sustainable purpose that makes us mitigate and think about jurisdictional risk differently, whether it's poverty, whether it's some other goal within, clean water within the SDGs. It gives you a frame to think about social issues that I think is very clear. And those are the two predominant bodies that folks are aligning to.
So I guess that leads us to the next question about how do we think about this as things move forward? Is it necessary to make a case from an economic perspective, or should we be thinking about achieving public goods or some kind of data-driven social returns perspective, or from a risk avoidance perspective, some combination? You referred, Lourdes, in your presentation to kind of this divergence in the municipal bond market of how folks were thinking about it. Let's just imagine for a minute that we get to say what should happen. How would you look at that? Which of those do you think are valid things to think about, and which are sort of straw horses?
That's a great question. If we were living in a perfect world, I think that we would have to situate the importance of, at least for in the municipal bond market for issuers, the economic argument, because it takes a lot of work and it is a different cost benefit analysis when you commit to designating a deal and then doing the additional reporting. That's hard, especially within the social designation, where really the level of complexity is immense on what you measure, how you report it, and also the liability that an issuer could face in making forward-looking promises that then don't materialize, because we know how hard it is to move the needle on these issues, particularly from an impact standpoint, when you are focused on population outcomes. But often many issuers say the economics has to be there, because if you don't bring more investors to the table and you're not generating a lower cost of capital, why take the risk? The project will still have the outcomes that it does in the jurisdiction, but maybe you don't have to put forward all the extra reporting, because again, it is a public project and still going to serve its purpose. And that's understandable. So I think in a perfect world, we would find a way to enable issuers to be bold with the social change that they want to achieve, or the way that they want to think about that project contributing to long-term sustainability, and create an enabling environment where both the data and the regulation would be supportive of issuers who want to go down that journey and maybe are resource constrained, and where investors would also take a wider lens on what it takes to give an issuer that discount, and give them credit for the wider spectrum of activities that could lead to change on both ends of the spectrum.
Yeah, I'll jump in here too, because I think it's really interesting. And I love what Lourdes says about that sort of tension of like, I want people to be bolder, but there is still a pile of money to be used there. When you bill it that way, you do get money. And I do think, for me, I'm actually, professional trained economist. I have a PhD in economics. So I think sometimes when we try to put the business case lens or the economics lens on it, we get very narrowly focused, as if money or, a specific, a specific return on investment is the only thing that matters. But, I told this story before, like when I was in socially responsible investing, my uber conservative uncle was like, what, you just don't want there to be any oil and gas companies anymore? How is that going to work? And I just looked at him and I said, I'm not saying there shouldn't be any oil and gas companies. I'm saying we are a place to park your money if you specifically do not want to earn a return investment on oil and gas companies. We have a place for you. We have a product. This is a perfect market solution. And that immediately shut him up, because there's really no arguing with that. And I think that money is not the only driver of these things. People do want to invest in high impact projects to improve a neighborhood, even if it might mean the return is slightly less. Like, that's not the only driver. And I think we get ourselves a little bit too narrowly focused in on everybody is just, worshiping the almighty dollar. And it's not true. People invest and want things for different reasons. And I can't say enough times, our investors are demanding this information. They are demanding that REITs report more, and they want to hear about it. So we have no choice but to say the business case is already there. I don't need to run yet another academic study on whether or not, investment returns are higher for companies that do well in ESG, especially when we don't even know what doing well in ESG actually. We have no consistent agreement on what that means. So I'll let Soojin chime in here.
Sure. Thank you both for your responses. I think they're really insightful. And Matthew, I really enjoyed this question because kind of how you wrapped it up is the ideal and the optimal. So we're a bit a ways from, I think, that stage at this point. But I think to Lourdes's point, there's a huge financial element that's part of this, where it's not just philanthropic. You do have investors at the other side that are essentially asking, where is my money? And a lot of people who work in ESG, to Nicole's point in her personal story, I think a lot of them think that the purpose of ESG is to make sustainability and doing good this the only reason why you might invest in a fund, and the focal point that even will eradicate certain industries, which by no means is the purpose of ESG. We think of ESG as a long-term risk. Like, it is something that is a financial risk. It's something that you should be considering anyways. And especially when it's related to ESG, or sorry, to real estate, these things are like, in 10 years, do you even picture that there being land for you to continue building on, or will the seashores, completely eradicate the shoreline, and there won't be anything there for you to build on? Is your energy efficient enough that you're really getting a good amount of output? Especially globally, we're really facing an energy crisis in a lot of different regions. So when you're thinking about optimizing efficiency and reporting on all of that, all of them are absolutely necessary reporting skills to have in order to have a viable investment. And that's really the bottom line, whether it's ESG, whether it's impact. At the end of the day, it's, are you really paying attention to all of the tiny corners to ensure that you're not overlooking a really, really great investment opportunity or an immense risk that could pose to you? And especially in private markets, where a lifespan for investment might be 5, 7, 10 years, you need to be thinking about how these things will affect you in the long-term cycle. So I think in my optimal ideal world, people won't necessarily think of ESG and a financially viable investment as mutually exclusive things, but they'll be so synonymous that you won't even think it's ESG. You'll just think, I need the financial report. It has these metrics in it anyways.
Yeah, I love that, Soojin. Like, we're just converging into where they meet. And I think that's already happened in certain areas that we don't think of as much. I'd be curious, Lourdes, if you can think of some examples, or Soojin, you as well, where, things that were, we just took for granted, we take for granted now as part of the business model. I think, we just don't hire only white men anymore. We just don't do that thing. Like, it's been integrated. While diversity definitely is maybe not where we want it to be, we sort of take it for granted that, like, we all sort of agree that that's not what we do.
Yeah, I could not agree more, with both of you, especially on that last point, that when you look at municipal bond markets and you think even about some issuances just within certain sectors like water and sewer, I mean, there is an extremely clear natural overlap to green. And, obviously you have to examine the project, but, there's a really strong argument that certain sectors really lend themselves to ESG naturally, whether or not they carry a label. And if you look at some of those investments, like, they're in portfolios for a reason, because they are generating market rate returns for tax exempt or taxable fixed income securities. And it's really hard to argue with that. So I really agree with kind of taking that lens and also asking ourselves, like, if we think about both impact and risk, aren't they connected? Because if you're achieving positive impacts in a jurisdiction, aren't you thereby mitigating sustainability-based risks and thinking about long-term resiliency for that community in ways that are positive?
Okay, I have to be the thorn in the side to keep this conversation going. And I, of course, like a world in which everything just converges, and we can imagine that people continuously understand that there are positive values to be had in just integrating these things, even if we don't call it ESG. I do spend a lot of time working in the South and in the West, and in lots of areas that the inclusion of a public good might be viewed as an incursion and something that was not welcomed. So I guess zooming out from that perspective, this last question, we were talking about whether or not we need to make a case economically, or from a data-driven public good perspective, or from a risk avoidance perspective. I guess the question would be, if we're not making those cases, how do we know that something was actually achieved? Up front, people jump in on whatever basis they do. I don't want to invest with oil and gas. I want to go in this other direction, or this long term is going to be a more risk avoiding strategy. But where's the moment at which there's a reconciliation of what was hoped for and what actually occurred? Isn't that a necessary moment in order to ensure the continuance of capital flows at the scale into this sector, or is that a confusion? Are we just using the label ESG to talk about something that was already happening, and so this is sort of a fake trend? Seeing that rise is just a labeling semantic thing, because in the end we're not going to measure anything differently. Sorry, that was a new question that we didn't prepare for, but I think it's warranted.
Sure. I'd love to get kicked off with that question because I think that really touches upon what we work at Preqin, being a data provider, because this is something that we have to face with data all of the time. Where do we make a decision to surface data and bring it live to our clients? Because with data and with people who are using it, they need to trust us and they need to trust that this data is reliable. And there are two parts I think that really get to the core of data reliability. And that is comparability and scalability, which pretty much everyone across the board is struggling with at the moment, because comparability, even within the real estate sector in and of itself, is really, really difficult to achieve, because I think with sustainability being fairly new as a focal point, and also in a lot of ways, we are seeing this unprecedented visibility into the investing space that we really haven't seen before. Like, you're seeing big banks headlining in the newspaper and in magazines and on, your daily, mail read in the morning or in your daily podcast. So there's this new kind of media lens on it where everything is under a microscope right now. So when you're thinking about, what data can we surface that is going to be applicable to everyone, even though no one really wants to get compared to each other because they're like, my sustainable approach is very unique, and the person down the road is doing a building that's like 3 floors taller than mine, so totally different. We can't compare the two. And on top of that, it's consistency over time and that scalability element. So when you think about what real estate looks like in New York City versus a small urban suburb, versus somewhere in Asia versus somewhere in Africa, like all of these real estate developments look very, very different. So when you think about, how do these compare today, but also are we going to be able to provide this to you year over year? If we provide you something today that we're making the best out of the comparisons, can we still give that to you in 2024 and in 2025 and in 2026? And without that historical breadth of data, what are we going to be able to do about it? So I want to say that's like a diplomatic spin on the answer, because I don't think I directly answered it. It's something that all of us are definitely considering, whether it's a reconciliation or whether it's more of a term that's here to stay. Hopefully something that we'll talk about a little bit further, which I think can hopefully get to the core of this, is really what the role of government and regulators have in this conversation, because I think they also, in my opinion, have a large role to play in progressing how this ends up going.
Well, let's go into that. And Nicole, I see you're coming unmuted, and I want you to respond, but I want to prompt you a little bit first. So I want to evolve this a little bit where Soojin took it, which is perhaps then should we rely on the government to standardize these kind of metrics? And I know Lourdes is going to have something to say about that in her sector as well. But just following on the previous question, I'll give an example that when the Urban Lab was looking at REITs last year, we noticed 2 REITs that I will not name check. Both quote SDG 8, which is providing decent work and economic growth. And both of them were in a space of commodity returns, like their economic returns were matching their peers. And both of them cited this UN SDG in their ESG report. And one of them said as justification in their annual report that they achieved it because they required all service providers and contractors comply with applicable laws relating to the payment of wages and benefits. That was their justification for SDG 8. And then the other one, quoting the same SDG, said their goal was to train 25,000 participants in the community through a community workforce initiative by 2025. And at the end of the first year, they said they achieved it because so far they had 5,672 people trained. So a very different approach. And how do we navigate selecting? How do I even express my preference for one of these over the other? Or does it just become kind of greenwashing, window dressing? And should the government step in then to try to create something that we can make more comparability, to use Soojin's terms, even though it will be resisted by every participant? Perhaps there's still something to be gained there. So Nicole first, and then Lourdes.
Yeah, I think so. I want to, taking all of that together, I think, yes, I think unfortunately, and again, we see this in our ESG dashboard where we're following all these different frameworks that REITs are following. Like, some standardization is helpful and necessary, and there hasn't been so far any leader that's taken the majority of the market share on that one. So possibly a government intervention is warranted here to just set the standards. But I also think, you know, I'm going to undercut everything I say. I'm going to say I'm a typical economist on the one hand. On the other hand,
I was just going to say, you have to live up to your PhD.
Like, to your point about those two companies and to the broader ESG discussion, ESG to me only really works if there is a constant moving target, right? So we looked at our dashboard, we've been tracking every year in the top 100 REITs if they have a female board member, and we hit 100% a couple of years ago, and we're like, okay, now we're going to track if you have 2 female board members, right? Like, our understanding of what diversity, equity, inclusion is, you know, bringing in new categories. It used to be race and gender. Well, the gender category has changed, right? You know, we didn't used to think non-binary or gender fluid before. So I think that there's an argument to be made that, yes, there has to be some sort of at least consistency in what you're measuring. Otherwise, you know, there's no ability to compare. But I would also say we don't want to get ourselves into a situation where the standards get set and then they don't evolve. We want to be able to say, we're looking at our modern world with a different lens, understanding environmental challenges differently, the science has changed, whatever it is, so that there's flexibility to keep pushing towards the next thing. And I think because of that, I never want to say, okay, this is it. This company has achieved ESG perfection and they're done now, right? To your point, it is frustrating to say, okay, what have they accomplished? But if they keep pushing the envelope forward, that there's no endpoint. And I think there really needs to not be an endpoint. So that's my 2 cents.
Interesting. I like it. Lourdes?
This is probably like my favorite question of the whole panel, because it gets at the crux of what's really hard about ESG and municipal bond markets, and also hard to evolve towards standardization. So unlike you know, the private sector and REITs, municipal bonds enjoy like a really special set of preferences, not just a tax preference, but from a securities law standpoint. They are the 1933 and 1934 Securities Exchange Act and Securities Act give them broad exemption from all the provisions except the anti-fraud provisions of what's called basically like Rule 10b-5 in Section 17A of the Securities Act. And what that means in plain English is that if you are an issuer of municipal securities, unlike a corporation like that would issue bonds, or even a REIT, and you know, those requirements that might attach, you don't have to file a registration statement with the SEC saying, here's my data, here's my information to sell that deal. If you want to do a public offering of municipal bonds and find investors like all of us who are on this webinar, and institutions like NYU and other endowments, there are rules that attach to your underwriter. So there's a rule called 15C212 that basically says, well, because you're doing this, then your underwriter has to make sure that you have what's called an official statement. But even with that, that regulation, the SEC cannot tell a municipal securities issuer what to say. They cannot tell them what to tell investors. They cannot prescribe the content of that offering statement. You know, that municipality basically has to look to the anti-fraud standards and say, I want to make sure that whatever I'm saying is not misleading. And when we think about an ESG designation, and you think about that rule really being the thing that governs your compass on disclosure, and there are no other standards and no rules that you have to follow, you really leave this to the issuer themselves and their deal team to say, what do I think is appropriate disclosure? And we could all say that, hey, when you call a deal green, social, or sustainable, or climate focused in the title, guess what? Like, it's a natural to think that an investor might think it's material and vital to see something around it, including maybe a report or an annual commitment to ongoing reporting on, what? Is it the metrics that you define? Is it industry metrics that are driven by science? It's very much an open question. And the hardest thing is that in order to think about the depth of regulation, you have to say, well, what kind of legal and regulatory change might have to happen if, let's say, the SEC wanted to regulate municipal markets in a different way that was closer to corporations or corporate registrants. And that's one of the areas that's significant and difficult when we think about standardization in the municipal market. And obviously that doesn't preclude folks on a voluntary basis, like the ICMA and others, going deeper and saying, hey, let's give you tools and resources to think about this area deeply, intentionally, and with rigor. But that's sort of, I think, the crux of standardization and what makes the data question really difficult for municipal bond markets. And the last element I'll mention is capacity. One thing we discovered in our research is not every issuer is the same and has the level of resources, even at a staff level, and access to data. When you think about some communities are as small as 200 people in America, and there are cities and towns that are that small, to issuers that are like the city of New York, huge variation. And we think about, what might standards impose of that huge variation of issuers and their capacities, absent resources to support them.
So in some ways, trying to apply a disclosure standard might create an inequitable outcome in and of itself because of the varying resources of those communities.
It might create standards that are really hard to comply with, and then would it chill market participation if you say, well, wait a minute, then I'm not going to call my deal if I have to do things that we are not equipped to do as a community, or that become cost prohibitive.
Mm-hmm. So staying for one more moment on the argument around measurement, I'm going to try to get a rise out of Nicole. We know that this idea of an evolution where we're constantly trying to not set the standard down so much that someone could achieve it and then sit on their laurels, I think is a really powerful idea for not having total standardization of measurement. At the same time, as we've seen the LEED and sustainability landscape evolve, we've gotten to a moment now where people can talk about carbon zero or energy use zero or waste zero. There are different elements that actually we can measure and say, in the case of real estate, this building is actually not making the environmental problem worse. And in some cases, it could even be making it better. That's very different from even 10, 15 years ago, when it was shown that LEED might not even correspond with improved building performance and sustainability. It's come a long way. But do we really know how to measure the S? We looked at a range of even definitions of the S. Is it important that we try to, do we really know how to measure it? That's just to spur you on, but is it important that we measure it? Because what would it mean if we did or didn't? Could there be a differential outcome based on whether or not we lean into that?
Yeah, so this comment is coming from, I keep saying to people, if one more person tells me they don't know how to measure S, I'm gonna like flip a conference table at a meeting and embarrass myself and probably get fired. So hoping that day never comes. Yeah, this is an argument.
Here. You could do it here.
Yeah.
First of all, we're not in the same room, so you won't
just turn around and
it's the academy, so you won't get fired.
Yeah, I mean, I find this so frustrating because this is what I did for a profession for a while, was measure the S. And I feel like there are two tensions here. One, I think that for a lot of reasons in America, at least, we don't think about people the same way. For example, if you pollute a river and kill a bunch of fish and maybe some people, you can have criminal charges filed against you. If you blow up your mine and you kill a bunch of workers, OSHA doesn't have criminal charges that they can file the same as EPA. We just don't consider worker safety in the same way that we consider other elements. We just don't. We haven't had as powerful a movement in this country on behalf of human beings as we often have on behalf of endangered species, let's say. So I think that there's a bias there that people don't necessarily want to admit to, number one. Number two, I think we do know how to measure a lot of these things. And I know Soojin has some thoughts about how complicated even just measuring diversity can be. I mean, as Lourdes said, like, that isn't one size fits all. Race and gender may work in some places, caste may work in other places. Like, there's different ways to think about that, and it's not universal. But I think that there's a sense of, when you disclose those numbers, it gets a lot more scrutiny, and people have a lot of reactions to it, because a lot of the S numbers are more visceral to people than some of the numbers that are X tons of carbon emissions. If you say I meant X tons of carbon, people don't know what that means, and I don't think they're going to react to it. If you're like, well, we killed 2 people this year, which happily does not happen as in so much of real estate as, say, working in, as a electrical worker. I think that there's a sense that I feel that a lot of this discussion that we don't know what S is kind of conceals that. We know what S is, we just don't actually want to talk about it. So that's my 2 inflammatory cents on that issue.
I can add to this because I think for our pre-call, there was a lot of really interesting discussion about what S means, especially in terms of a global perspective versus maybe a US specific perspective. And quickly touching upon what it means from a global perspective, I think the definition of diversity in the United States is very, very different than what diversity means, let's say, across Europe or in Asia as well. And there are also a lot of regulations, I think, that create kind of red tape around this, particularly in the UK. I'm now based in London, and the GDPR is something that is very, very strictly enforced. So getting access to information like that about an individual in terms of their gender and race are very hard to obtain, or even if you would prefer to disclose it in order to have better information in some form of central repository, that's actually restricted from you, because it's not even just protecting those who don't want to give the information, but it's also preventing you from distributing this information in general. So when you think about the US specifically and how they're approaching diversity, I think a really interesting topic we also touched upon is like how diversity also tends to be like the overshadowing importance when a lot of people think about S. So not only are these metrics really hard to attain, but a larger conversation about ESG when it comes to the S portion as well is, do we start with diversity? Do we start there? Do we perfect diversity and then do we move on? Or do we kind of try to tackle all of these in kind of this percentage way where we can say we've achieved 10% efforts towards all of these metrics across the board, and we'll continue to systematically improve those as we get a little bit more refined in terms of what we know about our reporting. I think a lot of that is, to Nicole's point, a very, very like a visceral and emotional topic, because people feel very strongly about what these mean, because especially with the murder of George Floyd, a lot of these are very reactive to a situation that creates a lot of politicized discussion in the United States. So it then becomes even less of a financial topic, but also kind of a segmented political conversation, which at least in my opinion, I don't think it belongs in that realm. ESG should be a bipartisan conversation where we can all work towards, better data, better investment decisions, and being able to really uplift a community wholeheartedly, despite which party you're on, but it becomes very quickly a complex and multi-tiered issue, which is sometimes at work and also sometimes at the dinner table for Thanksgiving. Who knows? But it definitely is engaging and sparking conversations and in pretty much every room, which can be a good thing, since more conversation can bring better data.
And I think one point that I'll add to that, because I agree fully with everything that both of you ladies have said, is in the municipal sector, I think that it's really hard to also think about to what degree will a municipal issuer articulate those forward-looking aspirations, saying this is the North Star we want to achieve with this building, this park bench, this road, this bridge, and then to build a measurement framework around it, because that can be really difficult, especially when you think about other interventions that could impact the S outcomes. And how do you decide what you're going to measure just in the context of that project, even though it is a public project, but if you have other layered interventions that intersect with what you're trying to do. So I think that and also the resource constrained element probably are really big pieces that manifest really uniquely in the municipal sector. And even though we think of the natural overlap between so many public projects and what the S or the E could mean in ESG, I think it's one of the things that we have to think about often changes the decision to designate and whether or not somebody will call out the ESG label, even if the project itself might have ESG considerations when we think about data and measurement. And I think in the S, it's really pronounced because it's probably the most nascent sector, with green bonds having emerged for a much longer period of time than we've seen social issuances, about 10 years versus 3 years, and the lack of standards that we talked about before.
Okay, we're getting to a close with just a few minutes left here. And one thing that we did in the pre-panel was allow you to get out of the yoke of my questions and ask each other questions. So I wanted to give each of you the opportunity to either ask a question of another, or feel free if you want to give kind of a closing statement about what you think the future here might look like, or an interesting piece of the future to you. Since I sprung this on you, does anyone feel comfortable starting rather than me calling you out?
Sure, I'll start.
Thank you.
So we've done a lot of comparisons, US to Europe, and the rest of the world. So Soojin, you moved to London. You are American. So I'm curious to hear, in the realm of ESG, what was different than you expected? What was the same? Like, what was the, when now that you're started in the space in a different country, like what are been some of the biggest surprises or changes for you?
Oh, that is a great question. I would say the way people think about ESG integration in Europe heavily differs to how people think about it in America, in the sense that a lot of countries in the EU take it kind of as like an obligatory thing. So it's more of like it is what it is. We feel kind of neutral about it. And it's already ingrained through some type of reporting demand that we have at some level. And you see this particularly in the Nordic countries, especially. They are very, very fixated on governance. And when you ask them, what are you doing about governance? They're like, well, we don't really need to do much. It's already ingrained in all of our systems, all of our reporting, all of our investment structures. And it's just kind of business as usual, if you will. When you think about ESG in America, a lot of it, again, becomes like a politicized issue, and it feels very kind of proactive. It feels like new creation of something. And I think all of us have touched upon this at some point, but the resourcing issue really ends up highlighting a huge barrier to all firms in terms of where they get involved with ESG, because the hardest part of anything is just starting. And when you don't know where to start, when you're really overwhelmed with how much you need to provide, and also like, especially given the macro environment that we're currently in, thinking about additional resources just isn't feasible for a lot of organizations. So when you want to think about doing good and you really need to face the question of financially, can I afford to do good? And the answer is no, you kind of feel almost like a guilt about that. So you're like, what can I start with? And, where can I begin my engagement? And that's why I think a lot of people are hoping that there's more government intervention or there's more regulation intervention. Some people actually think of those two organizations as similar roles, and again, both needing some type of influence on the way reporting is being demanded. And also on the other side, not just reporting, but one of the questions that I saw in Q&A was kind of how the public sector is rectifying some of the additional costs for ESG. And I know at least in the United States, which there's a huge opportunity in the New York City general area, is opportunity zone funds and providing tax incentives from the government of saying, we might actually be able to reduce some costs as long as part of your investment, you're kind of promising engagement in the community and helping us by building data centers, educational spaces, public playgrounds, and things of that nature. So that's a loaded question, and I said a lot of things. So I hope that answered your question, and I'll sum it up by saying everyone's doing their best. There is some greenwashing in the space, but I like to have the idea that it's not out of malicious intention.
Well, I'll fill time while somebody decides who's going to go next and say, I have a plug for later this afternoon. We're doing another panel as part of Industry Day. I have the unique honor of doing 2 out of the 4, and it's on financing social infrastructure. So very tied to what was just discussed. And in fact, really a great example of that convergence of things that would have been happening regardless of the ESG label, that now can kind of be called out. And so we could direct capital in those directions, both from the marketing standpoint of what investors want that Nicole's been talking a lot about, but also from the perspective of what actually needs to get built regardless. So it actually is a great example of that. Lourdes or Soojin?
Yes, I'll actually go next. I have a question for Lourdes. Something that we've been kind of observing in the data space is a lot of funds that are actually removing their sustainable related label because they can't keep up with the reporting. So there's kind of this divergence where we either see a firm do one of two things. They either decide, okay, I'm going to wait for regulation and I'm going to wait for alignment with my peers, or they take more of a proactive approach and they say, you know what, I'm going to pick myself up. I'm going to do something in-house that is completely curated to our investors and do something that may not align. And we might have to leave organizations, which could be kind of like a reputational risk for us as an organization, but ultimately it'll better serve our investors. So when you think about the municipal bonds market, as this isn't really my area of expertise, do you see them more creating like, okay, this is our own individualistic strategies, or are they kind of in that waiting space where they need alignment across the board?
That's a great question. And I think the activity that I'm seeing falls into the latter category. And I actually think there's both a plus and a minus. One of the deals that I showed you guys in the opening pictures of the slides, the housing project in California, it's from the CSCDA, and they actually have their own framework that says, when we talk about social housing and workforce development housing, this is what we mean. And they also cite to the ICMA principles, but they say we give deeper meaning with the work that we're doing. And, if you Google some of those projects, you'll see that a lot of the outcomes of whether they're achieving their stated mission are called into question. I won't cast judgment. I'm not a social scientist and don't have enough information about the projects themselves. But I think one of the heartening pieces about market innovation is that there are a number of issuers who on their own are saying, we have our framework, we are doing something deeper, particularly in the racial equity space, even that transcends the issuance. So governments that are creating their own policy commitments and equity frameworks across the board that govern all of their finances that then inform how it eventually is integrated into a deal. But the challenge that many point out is what happens when you have a proliferation of different approaches, and again, no standards to evaluate, well, what does the S mean? How do you know that it's a good deal? How do you know that you measure it and can compare it to another government? And I think that often when we look at least the heartening activity that's happening with issuers, I see a lot of efforts that are giving meaning to the S in significant ways. And part of what that could do is teach the points of industry convergence in the future around which standards could be built and the gaps that need to be filled.
Well, that takes us almost to the end, but Lourdes, if you want to squeeze something in, you can, either as a closing statement or a question from one of your co-panelists for one of the co-panelists.
Maybe like in 30 seconds, could you see where do we think ESG will be in 10 years? And I'm not going to go first on that one.
All right, I'll take the hit. I hate prognosticating. I'm always afraid someone's gonna look this up and then be like, "You were wrong 10 years ago." So, I think again, I think there will be a continued evolution. I think some standardization is going to happen, be it from the SEC's proposed rules or whatever. I do think in the US there will be some agreement upon some things that we want to measure. So I predict that will happen in the next 10 years. I predict the name will change again. It'll not be ESG, it'll be something else. And I think that the increased politicization, I'm going to be optimistic. I think that it might die back a little as you know, some of these things just become more mainstream.
Thank you, Nicole, for giving me some time to think. That was a tough question. Okay, 30 seconds, 3 quick bullets. One, I absolutely think regulators will play a bigger role in this. The FCA especially has essentially kind of signaled to the market that they are going to start cracking down on ESG ratings providers in the very near term. So we're going to see the rollout of that and the implications before the turn of the decade. And if the FCA is doing it, we're going to see players like the SEC follow suit. Gary Gensler, also a huge proponent of ESG, and we're going to see regulators all across the globe kind of follow that trend. The second thing is we all kind of know roughly what we want. I think we are looking for diversity metrics. We are looking for carbon metrics. We are looking for things like health and safety. And within real estate, you even see, again, those certifications coming more into play. So you do see kind of the front leaders of like what is probably going to be here to stay in the next 10 years. But the last thing I'll say, the third point, all of us pause. So there's also a huge question mark where ESG will be in 10 years. I think I'm also comfortable saying a lot of us just don't know, but that's kind of the beauty of it when you're talking to people and they're like, I don't know anything. So, you know, you can give me the truth and you're kind of like imparting that wisdom of saying, you know, I don't know the truth either. We're all in this together. So there's a big question mark and a lot of it we'll have to wait and see.
Awesome.
Great, thank you. Thank you all for attending this panel. Thanks, panelists. This was definitely one of the best panels I've had the pleasure of moderating. All of you are just so versed in your fields and so articulate and very data driven. So I really appreciate you bringing the A game here. Thanks again to Troy and June for helping to put everything together, including some preparatory materials. And as I said at the beginning, but you might have missed, the Urban Lab is going to be following up and generating at least one paper in collaboration with the Public Finance Initiative with Lourdes. We might do more than one. This is a very rich and interesting topic, so stay tuned for that. But we plan on releasing at least that one paper in the fall, and we'll have another event around that. And certainly we'll make that known to everybody. So thank you all for attending REIT Industry Day. And hopefully we'll see you in one of the later panels as well.
Thank you.
Thank you.
Thank you all.